Hey guys, good morning. It's been, to say the least, a crazy week in the world. Terrible week in the world as far as human cost and suffering goes, and terrible geopolitical news all across the world, as well as very high stress week in the markets. And I think when you're looking at the markets right now, it's really impossible to make any intelligent, fundamental prognostications because everything at this point really depends on how the war goes. And there are so many unknown factors. There's so much uncertainty, so much inability for people to handicap, not the least of which because the actors in the war, on the Russian side especially, are not acting in any kind of a rational capacity at this point. And the threat of sort of the ultimate risk has really elevated itself far higher than anybody thought we would imagine. And therefore, any kind of a prediction as to whether things are going to get better, we're going to create a ceasefire, it's going to be risk on, risk off, I think are fruitless. The only thing you can do when you're trading in this type of environment is two things. First of all, although we don't know whether it's going to be hopefully a positive resolution with with a limit on loss of life and some kind of a peace resolution, or a highly negative resolution where in kind of a situation where we have a war of attrition and a long-term grinding situation that could affect all of Europe, really have no idea. The one thing we do know is that when we're trading markets of these kind of highly volatile political risk, two things need to happen. Number one, you have to really lower your position size. And number two, you have to really widen your stops if you're trading in this type of conditions. Because uncertainty by its very definition means the volatility is going to just skyrocket. And regardless of whatever position you whatever economic side you want to take, whatever trading side you want to take, you can't survive unless you give yourself ample room to be wrong until proven right. Because the volatility here will just knock you out. So having said this, I think the two clearest instruments that are effectively what I would call war instruments, the war trade, is certainly obvious on the charts here with gold and oil. And I think it behooves us to take a look at both of those first and then come back to the other instruments and see how the week could possibly shape up for that. So looking first, let's say at oil, which is, I think, of course, the poster child for this war. What's obvious from the charts and what's obvious from the situation here is that we're now facing potentially a massive, massive squeeze in oil supplies globally, especially at a time when global demand is still remains relatively buoyant. I think that's the other sort of a subcomponent of all of this situation is while the war is horrid and the geopolitical risks are enormous, the underlying economics everywhere in the world are actually quite good. U.S. just blew out its labor data. There is still very healthy demand underlying all of this. And if you would just simply use the John Lennon line, "Give peace a chance," there's quite a strong argument to be made that growth is really the proper trade. But for now, as I said, it's really a geopolitical game, so it's hard to really gauge. That having been said, though, this is clearly a melt-up move in oil. And the easy trade, sort of like the conventional trade here, is to say oil is skyrocketing even higher as we're going to get further squeezes on supply, and therefore it's simply you simply buy and close your eyes. I think a more nuanced and more interesting trade to do is to consider the opposite scenario. Let me just go through weekly charts here. Let's see if I can pull up the weekly range, or the monthly range, sorry, the monthly range. And here you see, I think, a very, very interesting scenario just on the charts, which is the only place when we're dealing with these type of situations that we can find any reasonable trade structures. So when we're looking at the charts here, first of all, you see that we have a near-term resist at this 115, 120 level, but then, of course, the much higher resist at the 140 level. So yes, is there potential for possible 20 more points in oil? Certainly. But there's also potential here that we could be nearing a blow-off top. And a more interesting, although obviously a less conventional trade, would be what I would call a scale-up into oil trade. In other words, you short a little bit at 115, you short a little bit at 120, you short a little bit at 130, with a hard stop, has to be a hard stop at 150. That's where the terminal trade, the terminal velocity of the trade simply takes you out. That sort of suggests, a truly panic conditions in oil. You really, there's only so much pain you could absorb in that trade. Now, the reason why the fade trade going against the trend at this point is kind of interesting to me is because, as I said, number one, we're vulnerable to a pretty severe correction to the downside. Like right now, I posted on Twitter last week a poll saying what comes first, 120 or 100. And given the conditions, given the near vertical panic, I think in the marketplace, it would seem that 120 should have been an easy move. And of course, the poll was 75% 120, only 25% 100, which again, as a contrarian and as someone who believes that the majority is it's very difficult for the majority to be right in the markets all the time, because that's not how the markets reward risk. Makes me think that there is a potential here that we could have a swish to the downside on any sort of Russian pullback. Even if we sort of come back and say they're going to pull back to Donetsk and the Russian ethnic Russian areas of Ukraine and come to just a ceasefire, would probably create a relief rally in oil that could flush everybody down to 110. It doesn't mean that I'm net short oil in the long run. I'm just simply talking about tactically over the next week. To me, the tactical trade here seems to be the more interesting trade is the short trade, but at small sizes in a scale-up fashion, because you really can't gauge what a top will be and exactly the break of this parabolic move. But I think it's worthwhile to take it that way. Similarly, when we look at gold, it's very much sort of a similar situation, because if you look at gold here on a monthly basis, right? I think am I on the monthlies? Let me just go to the monthlies. Here's the monthlies. Yes, the monthlies is very much at multi-year resist levels. This whole 2,210. I remember this 210 level as clear as it was yesterday. This was the panic COVID highs, right? And as you can see, once that level kind of got reversed, it was a brutal sell-off for 300 points down in gold. I think we might be setting ourselves up similarly for that type of a pump and fail move. So here again, you're in at 1950, in at 2000, even in at 250, maybe even 2100, with a very hard stop at 2200. Again, a scale-up trade, which I think is very possible for a reversal move here towards 1900, perhaps even 1850, as you get liquidation on any type of risk relief move that we could possibly see. I'm not calling for any risk relief move. I'm just simply trading this tactically and using the charts as my reference sources, simply because neither I nor anybody else in the world knows what happens tomorrow, much less in the next 3 days, given the conditions that we're in. Now, looking at other charts and looking at, let's say, Bitcoin here, the situation is less clear. I mean, if gold and oil are the pure war trade, then here the situation is less clear as far as where is Bitcoin. A week ago we were very bullish Bitcoin. It rewarded us well in this move from 36 to 4,400. But what's interesting is that we did not take out this 45, 46 level. And frankly, if you're sort of looking at Bitcoin from a purely technical point of view, you are really not in a bull market. You're really not in a indubitably buy mode here, until and unless you take out the 46,000 level. That's a very key resist level. For now, it still looks like a distribution and a consolidation chart. That having been said, though, if you're looking at it from the other side, we haven't broken the 36s. We haven't really broken the 34s. Anywhere where you're sort of, or if you sort of really want to look at the extremes, we haven't really broken this 32s, which is really the key support level. So I think the only thing we can say with any degree of certainty is that Bitcoin is consolidating, but not having broken its lows. The bias may still be up. So to me, the move, let's say, if we can take out 40 by Monday, hold it, the chance of us regaining strength to go back up towards the 45, 46 is relatively strong. I'm certainly not as bullish as I was the week prior, but I am not bearish, and I would say mildly bullish Bitcoin, given the conditions that we're seeing here. Because ultimately, still, you have a situation here where this is the one digital asset that everybody in the world can own in a portable fashion. There was a huge amount of speculation that a lot of Russian oligarchs had transferred their money into Bitcoin in order to avoid sanctions. That apparently hasn't happened. The market apparently ran ahead of itself in its assumption. But that doesn't mean that it's not a bad assumption. It doesn't mean that even if the oligarchs don't move their money, the man in the street everywhere in Eastern Europe is going to begin to really hoard a store of value asset, which is very much Bitcoin. But it is a highly momentum-driven volatile asset. You have to trade this on a technical level. So for now, I still think it's mildly bullishly biased. You stay long and hold the 32 as your stop, and just assume that this is a consolidation move with a general reversal back up to the highs as we find new value for the asset. Lastly, amongst the four major assets, when you're looking at NASDAQ is really the poster child for risk on, risk off, right? I mean, the irony of the whole thing is that conditionally, as far as economic data goes, there's still a tremendous amount of strong demand. And ironically enough, of course, nobody's looking at any kind of a rosy scenario. But imagine you could have, and this is obviously a completely out-of-box, unconventional scenario. But if you have a situation where you have a regime change in Moscow, and you have an oligarch like Roman Abramovich, for example, who can step in and essentially assume leadership. Even though most people would think that's a terrible situation, that's actually a tremendously positive situation from an economic point of view. If you put in someone with an economic foundational basis, if you put in someone who is able to understand the basic mechanics of economics, U.S. and Europeans would very likely lift all the sanctions, allow Russia to reintegrate back into the global economy. And that would be massively positive risk, because at that point, Russia would be run much more as a, let's say, a Singapore-like or even as China-like situation where you may have a hard authoritarian government, but one that is focused on economic efficiency, not one that is essentially run by an ex-KGB colonel who knows nothing about economics. That's a very, very far-fetched scenario, but still, the point being is that it's not at all far-fetched to imagine that risk on a foundational level, economically, risk on is still a very dominant trade. That having been said, though, it's really hard to make a case that you want to get long NASDAQ. The one thing that you could say is that you could probe the trade here because you have these spike lows here on the 13,000 that so far have been rejected. But generally, and this is where I caution you, these type of spike lows and a bounce actually don't suggest that you have a reversal move. A lot of times the market likes to just come back and retest these spike lows. So honestly, if you sort of bet short oil, short gold, which is the short war trade, the proper offset here would be to get short NASDAQ, which would be long war trade as a kind of a hedge. So if you're wrong on one side, you may want to hedge yourself by going short the other side. That would be the more intelligent trade here, I think, as far as assets go. Now, having looked at all the major assets, I think we've left FX to the side, and I think the reason why I've left FX to the side is because it's really very much its own special case. And let's take a look at Euro here first, because Euro to me is absolutely the central story in FX. So the central story in FX, when you're looking at it from a fundamental point of view, is that where is the war going on? The war is effectively going on in Europe. Therefore, the region most economically vulnerable to the war and to economic dislocation and shock is Europe. And it's no surprise that Euro now broke the 110 level on Friday's news. And if we are indeed in a situation where Russia forces take over Kiev, Zelensky has to flee or is unfortunately murdered by the Russians, it's very likely they're going to get further downward pressure on Europe, because at that point Russia will then just act as a stranglehold on Europeans' and hold them hostage on their gas revenues and everything else that's happening. Very, very hard, again, as I said, to war game this scenario. You're not quite sure how things are going to go. Euro bounced off the 109s on Friday, just kind of on a risk relief basis, and there's certainly potential scope here for it to kind of short cover to 110. This is what FX does all the time. It likes to fake you out, but overall, very hard to say that this indeed is the bottom in the euro move. In fact, you could really make a stronger argument that this is the start of a further trend down. Now, the cleanest way in many ways to trade this is to say, well, if Europe is a trouble spot, where in the world is the least amount of trouble spot? And I think it's very clear the least amount of trouble spot is absolutely on the other side of the globe in Australia and New Zealand. Not only are they completely away from the conflict, but they also are the major beneficiaries of this move because of commodity prices actually being inevitably going higher, and therefore both wheat and energy prices are going to skyrocket. So with that, Australia, of course, is both a commodity and an energy producer. So Euro Aussie is an interesting trade. Let me see if I can pull up. I don't think I have Euro Aussie on my chart here. Let me see if I can pull it up. So here's Euro Aussie on a daily chart, and you can see it's a vertical swan dive. Now, when you're facing with these type of trades, it's extremely hard to say, oh, we got to get short here because the move has already been so grand. But honestly, it is at these kind of parabolic vertical moves that you could have even further acceleration. So I think as news gets grimmer, this is a trade to the short side, perhaps even all the way up to the 145 level before you find any type of a support. Here again, you have to trade with relatively larger stops. But fundamentally, this type of a trend, which is very, very unique, and you can see these type of trends really don't happen, except in a very clear, unusual situations. Do not just stop on a dime. Do not reverse, especially in a situation where the longer term implications are quite negative for Europe, relatively positive for Australia, and certainly the other trade that's been the poster child here for all of this is the Euro-Kiwi trade, which also, by the way, broke very long-term support. I mean, we can go to the monthly charts here to kind of find ourselves, and we see that monthly there is scope here all the way to the 145 level before we really run out of gas on this move. In fact, if you're looking at the monthly charts, the trend looks like it's just started. We just took out the major support levels. But here too, if you're trading this thematically, you absolutely have to give yourself massively large stops and targets in order to be able to stay in the trade. So here, if you're going to take the momentum trade to the downside, you'll really have to almost give yourself 500 points of risk to try to see if you can make 500 to maybe even 1,000 points to the downside. So that's, I think, how the week shapes up. You stay momentum on the FX side, where the fundamental news is just not going to be cured by overnight movements, and perhaps fade the commodity trade on any kind of assumption that we're just overbought and you have some out of consensus short liquidation, profit taking going on that would then help all of your short positions. That's how the week shapes up. I hope everybody peace and easiness in the marketplace, and let's hope that this whole situation ends by next week. Unfortunately, I don't have much faith in that happening. Wish you guys the best of luck, the best of trading. Boris Schlossberg, over and out.